It's no secret that recently we have seen a lot of changes to the real estate market, and a lot of people are wondering, how is the rest of the year going to play out? Realtor.com has analyzed the data and they have released a mid-year update. This is an update to their 2022 housing market forecast, and they are saying that more options should be available for home shoppers. So let's dive into this and see what Realtor.com is predicting we have in store for the rest of the year. They start off by saying a moderating housing market means more options for home shoppers. So the key points that we're going to break down in this are as follows. They say that mortgage rates have been revised upward to reflect the major shift in monetary policy and financial conditions over the last 6 months. In the second half of 2022, we expect a continued climb at a more modest pace, which means that rates hit 5.5% by year end. Next point is, going forward, home price growth cools, but it has remained hotter for longer than originally anticipated, leading to an upwardly revised projection of 6.6% home price growth for 2022. So they're still predicting prices are going to rise. The Realtor.com economists are shifting their original 2022 growth expectations to a decline of 6.7%. While we now forecast a notable step down from 2021, home sales on par with these projections would mean that 2022 sales are the second highest tally since 2007, trailing only 2021. The number of homes for sale grows more than originally projected. The growth is driven by a combination of more sellers and a slowing of home sales pace. So this is a nice little graph that they made of how they are changing their 2022 forecast. So this right here, this section is the update compared to what they initially put out. So the next big point in this whole section is about the changing economic landscape. And this is really the first pillar that they are making these changes on and why they are doing this mid-year update. So inflation is high and monetary policy pivots. The change in financial conditions is the most dramatic driver of change in our revised outlook, as we just talked about. As we finalized our results in late 2021, the consensus on inflation being a largely transitionary phenomenon that could be tamed with a garden variety tightening cycle was just starting to crack as inflation accelerated from just over 5% in August to more than 7% by December. In the December 2021 Fed meeting, decision makers accelerated the planned end date of the Fed's asset purchase plan and raise expectations for short-term rates by the end of 2022, just shy of 1%, which would imply roughly 3/4 point rate hikes in 2022. In its January 2022 meeting, the Fed signaled that their plan to begin rate hikes at the March 2022 meeting, and markets responded. In the span of roughly 2 months, future markets had repriced a March hike from a long shot to a near certainty, as you can see in this graph here. So the main thing that's driving this change can be seen in this red arrow here, which was that the 2022 rate expectations in March were up already by 120 basis points from when they made this prediction, when the 2022 housing forecast was modeled and then continued to climb. So the Fed followed through in March, and in addition to lifting the Fed funds rate, their economic projections signaled that more and/or larger rate hikes would be needed than expected in December. At its recent May meeting, the Fed made good on those projections, raising the short-term rate by 50 basis points, the biggest hike in 22 years, and setting the groundwork for more large adjustments basically coming in the next few months. Because inflation does not respond immediately to tighter monetary conditions, it has continued to surge, hitting 8.6% in March before easing somewhat to 8.2% in April. We expect that inflation will continue to ease as demand responds to tighter financial concerns, but remain high enough to pressure the Fed to continue moving short-term rates rapidly to neutral. Once we hit a growth and inflation neutral short-term rate, likely in 2022, we expect the Fed to pause and assess the impact of the actions on the economy before deciding whether to hold or pursue additional hikes. Mortgage rates will likely continue to climb, but at a slower pace, as they are largely adjusted to anticipate the Fed's hikes throughout the end of 2022. So they stay on mortgage rates for a while. They go on to say that mortgage rates are currently more than 2 percentage points higher than this time 1 year ago. In combination with higher home prices, this has caused monthly mortgage payments to soar by more than 50% relative to just 1 year ago. This is for a home buyer financing 80% of the typical home purchase, aka putting 20% down. This is roughly an extra $600 per month. While the higher costs have dampened homebuyer demand, knocking some households out of the hunt for a home entirely, consumers expect mortgage rates to continue to climb. This means that home shoppers who continue to search will feel a strong sense of urgency to act quickly in hopes that they may secure a lower interest rate. So take a look at this graph that they made here. They are using what your monthly payment would be at the interest rates where they currently are at a certain fixed period of time. And you can see how this is charted out. So your monthly payment is up 55% year over year and over 73% if you're looking at the past 2 years. The next pillar, if you will, that is really influencing Realtor.com data analysts to revise their current forecast for 2022 is the employment and income. They say while the number of jobs in the economy has yet to reach its pre-pandemic high mark, it is rapidly nearing that threshold. This is good news for the economy. Meanwhile, the pandemic's lingering drag on labor force participation and a strong economy driving demand for labor have pushed the unemployment rate down to just above its pre-pandemic 50-year low, putting upward pressure on wages as firms compete to attract and retain workers. You can see this down here in this unemployment rate graph that they've got. We are all the way down to like 3.6. And look at where we were in like 2019. We have way come down from where we were early to mid pandemic. They go on to say, we expect these conditions to persist through the end of the calendar year with the unemployment rate averaging 3.5% and wages growing by an upwardly revised 3.8%. Although wages do not keep up with inflation, they continue to grow at above average rates, and the sense that jobs are plentiful boosts consumer confidence and enables workers to change jobs at higher rates than in the past. And while workers return to offices in greater numbers, increased workplace flexibility is expected to be one of the long-lasting legacies of the pandemic, weakening the tie between job centers and housing and enabling some home searchers to circumvent higher housing costs by relocating. This is something we've talked about before. A lot of you may be in a situation where your employer is totally fine with you continuing to work from home or work remotely. So in that case, if you have that freedom, then all of a sudden you may no longer be trapped and confined to a very high cost of living area. You may have your say and the ability to move and work from wherever you want. The next pillar here is economic growth slows as crisis-era fiscal stimulus fades and global uncertainties weigh. Forecast GDP declined between our end-of-year forecast and updated inputs now as inflation and tighter financial conditions each take a larger and larger chunk out of real growth. Real GDP growth was revised from 4.3% in 2022 to 3.2%, so current inputs suggest that the economy continues to see nearly trend level growth in 2022. However, risks to this projection still remain. First, as pandemic aid winds down, fiscal policy becomes a mathematical drag on overall growth. And in fact, the first quarter of 2022 saw weaker GDP growth largely because of a decline in private inventory investment and pullback in government spending. Second, even though the Fed is pursuing a soft landing, tighter financial conditions will weigh on growth as consumers and businesses alike face higher borrowing costs. Third, the war in Ukraine began more than 3 months ago, and ongoing economic disruptions from China's COVID policies are also risks as they are likely to disrupt supply chains and feed into general uncertainty, consumer unease, and additional price increases. This section might impact you the most. We're moving into the key 2022 housing trends. So this is the state of housing. The housing market settles down as home sales moderate and price growth eases. So they go on to say, over the last couple of years, the housing market has experienced significant ups and downs. Substantial pre-COVID sales momentum was brought to a halt early in the pandemic, only to be unleashed as the economy slowly reopened. Home sales activity hit long-term highs unseasonably late in 2020 as consumers tried to make up for the largely lost spring season and capitalize on falling mortgage rates. The momentum carried into 2021, waning a bit in the peak spring and summer season before re-emerging later in the year as concerns over rising mortgage rates emerged, causing buyers contemplating a move to hurry up and beat the rising interest rates. In 2022, we witnessed the early year housing frenzy give way to tough budget realities as rates hit decade-plus highs and home prices continued to surge, causing some homebuyers to postpone home buying plans in the face of higher costs. Home sales activity finished 2021 and started 2022 off better than previously expected, but cost challenges have caused us to revise our outlook for home sales down lower. We now expect home sales to slip 6.7% in 2022. We expect to see the biggest year-over-year weakness in home sales in what's traditionally the heart of the summer selling season. I'm thinking that they're likely saying that we're going to see the biggest slip really right now because it has not been that long since mortgage rates skyrocketed. I'm getting tons of messages from you guys still wondering, what are rates supposed to do? Is now still a good time to buy? Can we expect another big opportunity for buyers coming soon? Hopefully by the end of us making it through, you will be able to see that I think there could be another good buying opportunity coming up. They say as we move into cooler months, both buyers and sellers have an opportunity to recalibrate their expectations of the housing market. We expect to see somewhat greater transaction activity, but sales will still lag year-ago pace. As conditions shift, we expect home purchases by investors to slip by a relatively small amount, while home buyer purchases for both primary and secondary homes decline by a larger amount. This causes the share of purchases by non-occupiers to grow, while the share of homes purchased by owner-occupiers declines, which puts pressure on the homeownership rate. Of course, they're going to talk about builders as well, saying that construction remains sorely needed in a housing market that is still undersupplied. The government has taken note, with the White House rolling out a plan to tackle the housing shortage, primarily by making it easier to permit and fund smaller, more affordable homes. If you haven't seen my recent update about what the Biden administration is trying to push in terms of affordable housing and new construction, I'll link that up here so that you can check that out. Much like overall sales activity, single-family housing starts finished slightly stronger than expected in 2021 and are poised to build on that momentum in 2022. They expect single-family housing starts to hit a new 16-year high in 2022. But they go on to say rising costs and labor shortages will present challenges for builders to work around, on top of waning optimism and top-line pressures as housing demand softens. So you can see, really, ever since about 2011, we have seen a pretty steady increase in single-family housing starts. But I can say, first and foremost, as someone who is in the process of building homes and speaks with builders on a regular basis, the costs are still extremely high compared to where they were. You've got labor, which is still an issue, and a lot of builders are still uneasy about what the market is going to do. Will buyer demand stay up? So I'm actually a little bit surprised by this 16-year high that Realtor.com is predicting. I think it's possible, but I think it might be a little bit of an overshot just compared to the conversations that I'm having on a daily basis with builders. Moving on, they go on to say home buyers see the number of options improve, but costs remain high for both buyers and renters. Newsflash, we all know this. They say our forecast revisions highlight challenges and opportunities for buyers. While housing costs remain high, pushing home shoppers to make tough choices about their budget priorities, the number of homes for sale is expected to continue to grow, building on the turnaround begun in May. As more homeowners look to make adjustments to fit changing personal needs and take advantage of favorable market conditions to access the significant amount of equity they have likely accumulated, home shoppers will have more choices. This may even lead to a reinforcing cycle as more options bring out other seller buyers. So people who have homes to possibly sell, who would then buy another home or a new home. For those households who simply can't keep up with the rising cost of home buying, renting may be the better option. But for other renters, especially the large number of millennials near prime first-time home buying age, fast-growing rents will fuel persistence in home shopping. They go on to say, for persistent home shoppers, shifting market conditions may make this fall typically one of the best times of the year to buy a home, particularly opportune one. And I think that they're saying that because they're predicting, at least as of right now, that interest rates have probably hit a little bit higher than they will even out at by the end of the year. In addition to that, they are anticipating that we are going to continue to have more inventory hit the market. So when you combine some people, frankly, continuing to get priced out of the housing market, so buyers pulling back, choosing to rent for a little bit longer, you have more inventory coming to the market, you have potentially a good opportunity to where there is less competition on the buying side. Now, is this something where there's going to be no competition at all, a giant surplus of inventory, and we're seeing, houses sit on the market to where all of a sudden price drops left and right and you can get yourself a deal, steal a house? No, not by any means. But what this is saying, in my opinion, and what I am slowly starting to see as someone who's working in the field, is that we may get to a point by fall, by the end of the year, where you're not running into as many multiple offer situations, and you may be able to buy a house for the list price. You may be able to get to a point where you're negotiating closing costs, or at least not waiving as many of the things that have been necessary. Maybe you're not giving an appraisal gap guarantee. Maybe you're not waiving your home inspection. So these are all good things for buyers. Maybe they're, this is not a giant crash to where you're going to be able to get this lowball deal, but these are all things that are going to be working in buyers' favors, giving you a better market as a buyer. They really round out this article talking to home sellers, and I want to go through this for any of you who may be in that situation right now where you could be a seller buyer. Maybe you're thinking about cashing out in a higher value market and moving to one where you can get a lot more for your money because you have the ability to work remotely. Or maybe you're just thinking about getting a different house because you are in a different stage of life. This section is particularly for you. It says that homeowners continue to be in an advantageous position, especially those who have owned for longer periods of time and accumulated significant equity in their homes. This is likely to bring out more sellers hoping to capitalize on favorable market conditions, which will ultimately mean more competition and a rebalancing of the housing market away from the very seller-friendly tilt it has recently had. This will bode particularly well for seller buyers who have been more frustrated with the lack of buying options. Seller buyers are not immune to the challenges all buyers face, such as higher home prices and mortgage rates, but home equity insulates them from some of the impact, particularly those who have lived in their homes for a longer period. With more equity to leverage in a home purchase, seller buyers can make a larger down payment, minimizing the amount that they borrow and taking some of the sting out of higher mortgage rates. This year, the return of seasonal trends and timing of mortgage rate increases are reinforcing each other, and I expect that the market will cool off notably as we continue to move toward the end of the year. This means that homeowners contemplating a sale should consider acting sooner rather than later. Another key takeaway in a transitioning market is that potential sellers need to be plugged into the latest market information and not let their expectations be too swayed from the past. If you are a seller and you think that you're still going to be able to price your house extremely high and you're not really plugged into current buyer demand and what buyers are facing with higher interest rates, then that is what we're really seeing right now, where you're starting to see some sellers need to do price drops. It's not necessarily that the market is going down. It's just that a lot of these sellers have been overhyped by the headlines and by how crazy they have seen some buyers go to get in a house. They say, While recent sellers have indeed benefited from the competitive market conditions, often selling quickly to buyers willing to waive contingencies and even pay more than asking price, even in this hotly competitive market, some sellers, roughly 1 in 5, experienced offers falling through and even a lack of buyers at the preferred price point. In fact, while the share of sellers having to reduce their asking price to find a buyer remains lower than pre-pandemic levels, it rose from 1 year ago in March, April, and May. So we are not anymore in the market that we were just a year ago. Things are already starting to revert back to how they were pre-pandemic. The interesting thing will be current homeowners evaluating what their priorities are. And I don't think we're going to see many people who have bought their home, I would say in the last year to 2 years, with like historically low 2 to 3% interest rates, list their home, because those are just like out of this world low interest rates, right? But the people who bought their houses several years ago, right? Like I talked about in one of my other videos, I bought my first house at a 4.25 interest rate. So if we get to an average of a 5.5% interest rate by the end of the year, going from a 4.25 to a 5.5, it's not the end of the world if I have a lot of equity that I'll be able to cash out and then put into a new home. So I am keeping the amount of total financing to a minimum. I probably will be better off in that sense, but I don't think we are going to see people who have bought their houses in the past few years who paid a premium and were able to lock in a really great interest rate list anytime soon. So let me know what you guys think of this. I will have the full article in the description box below. I think that this is really great. I think that there are some favorable opportunities coming up for home buyers, as well as this is a positive outlook on our market. I'm Nicole Nark, Arkansas real estate broker, with videos to help you find your way home, and I will see you in the next one.